Yeah, it's good to it's good to see this kind of in market breadth. It's good to see that Abha, in the short term, more than the economy, the sentiment and the narrative matters. When you are scared, you will sell irrespective of the value, and when you are fearless, you will chase stocks irrespective of them being overvalued. Will this package change that narrative? Will this package give that confidence? Will this package ensure that somewhere, hopes and perhaps a ground has been laid for big, deep-rooted reforms? When there is a problem, when there's a crisis, if you are able to use that crisis to really do deep-rooted reforms, trust me, the resistance will not be there. On the labor front, on the land front, these are very complicated reforms. And this crisis, in a sense, can be really used to marshal and change some of these reforms which on the supply side has been coming on our growth path, so to speak. And these are also important considering that these are not easy reforms to implement. I mean, when you have a crisis like this, I guess the path of resistance is not going to be there, and that is what I think the Prime Minister alluded to, and that is what I think market takeaway should be. Meanwhile, I want to talk about Vedanta. They're looking at delisting. We haven't spoken about it because we were focusing on other things. And then Jubilant Life Sciences, a pharma company which now has got a in principle and exclusive approval along with Cipla to make Remdesivir. Nilesh Shah of Envision joins us. Nilesh, good morning. Let's start with a zing in your voice.
Good morning, Nikunj. I think it's been a great day. I think fantastic last 12 to 14 hours. Brilliant announcement coming in from the Prime Minister. I think one of the most bold statements coming in from his side, especially on the economy. And of course, there is the big bang stimulus out there. But I think what was more important was clearly the statement of intent as far as undertaking some really tough, difficult structural reforms, which in a way could basically revive and recharge India's moribund investment cycle. So clearly, I think the stimulus plus, of course, the follow-up with the reforms, in a way, could basically ignite the animal spirits amongst producers and investors in terms of the real economy. And I think that's essentially the big takeaway of what's been happening in the last 12 to 15 hours.
So let's say if you're buying into pharma and consumer names, Nilesh, as a money manager, would you now be saying that, look, I would buy into, let's say, manufacturing and cyclicals? I mean, would you start shifting the beam balance of your portfolio based on yesterday's indication, announcement and statement of facts by the Prime Minister?
One will have to now start being constructive about manufacturing and services play. Those kind of businesses, which I think essentially will be a proxy to essentially India's domestic growth. Of course, so far, India's domestic growth has been driven by consumption. But clearly, I think with the kind of structural reforms which the Prime Minister has spoken about and a fall in interest rates, clearly believe that essentially a lot of those kind of businesses will begin to look very, very attractive. Of course, it's going to take some time because the reviving an investment cycle is not as easy as essentially putting money in the hands of consumers and they start to buy next day. This is something which will take several quarters for things to start rolling out. So I think one would probably have to now start being more constructive and more positive about that space. And of course, have your list ready and use maybe the volatility over the next few quarters to start accumulating some of the chosen names, which essentially would be a great proxy for that. So yes, I think from a long-term perspective, one needs to be constructive. And in the short to medium term, use the opportunities, use the volatility to basically start buying into some of those kind of businesses and names.
I'm going to ask you a difficult question, Nilesh. You've always said that for investors like yours, it's difficult to predict the short term. But short term right now is important because environment is such. Nifty is at 9469. Let's put it 9450. Where are benchmark indices headed post the government stimulus? Do you think markets will settle in a sharpish range of 9,000 to 10,000, or the range could be somewhere else according to you?
Well, it looks like that for now, at least, this will be the range, or this could probably be the range of 9,000 to 10,000 on the Nifty. It's just that I think this range will be contingent on basically how global markets are, because yes, of course, today is a great day, and maybe even a very short term, the markets will find support and maybe even will continue to find upward momentum. But having said that, clearly, I think you have to keep in mind that global markets have rallied quite significantly from the lows of March. And it's quite possible that we might see some corrections in the global market as well. And it depends on how sharp and how deep those corrections would be. And if there are sharp corrections there, then maybe the floor of 9,000 could pretty much well be not just tested, but perhaps be broken as well. We have to keep in mind that the next 2 quarters essentially are going to be very challenging for the banking sector as a whole. And that has a very, very large weightage in the Nifty. So if essentially the market does start to take a slightly more negative or a pessimistic view of the banking space, then that's where the biggest pressure point could really lie for the Nifty. So I think it's going to be dependent upon a lot more on how essentially global markets play out, and how deep the stress in the banking sector, and especially amongst the private names, really extends. So those are the 2 factors which I think will determine whether we break the bottom or not, the lower end of 9,000. In terms of 10,000, it looks very unlikely right now that 10,000 could be broken on the way up. But I think probably the big joker in the pack could be that if, as part of the stimulus, if there are a lot of fiscal stops for investors into equities, like elimination of LTCG, the long-term capital gains tax being removed, or dividends becoming taxed in the hands of investors, then I think that could provide a fresh upward momentum to the Nifty, and which could make it basically take out the levels of 10,000. But otherwise, I think for now, 9 to 10,000 seems to be a reasonable range.
Sure. I must add over here, before I get back to Nilesh, that opening gap of 4%, by the way, is getting sold into. Just look at how quickly we've eased off from that 9,500 move. 94.58 now for the Nifty futures, and we're holding up 244 points. So there is that bit of a cool off which has come in from the top. While it's still great going for an ICICI Bank, for a Vedanta, for a Hero MotoCorp, wherein 3 out of their 6 factories in India have actually resumed operations, and Axis Bank is looking good. L&T, HDFC Bank are all holding out along with Maruti. But Nestle, after its numbers, that's eased off about 1.5%. There is some weakness coming in on IT names. I wouldn't say weakness, but they're not really participating in the rally. Let's just, replace the phrase with that. So TCS is softer by about 0.6%. There's Reliance as well, which is down about 0.4%. Bharti is flattening out about 0.5% or so is the kind of dip. And Asian Paints as well, Britannia, etc., they're also easing out as we speak right now. So it doesn't, seem that this rally, the gap up, is very durable, at least as of now. I could be biting my words, but 94.40 is where we're at. We're already down 1.5% from that opening gap. But Nilesh, to the other point, the point that you're making, that the reality has to set in, and it will at some point in time. We've been drawing comparisons about the NASDAQ actually turning positive year to date, and, we've still underperformed. We fell with the global markets. We saw the recovery play out in April with the global markets. But now, if the global markets were to fall, considering they've had a far intact recovery, unlike ours, do you think we're going to fall further with them as well then?
Oh, absolutely. I think clearly India will participate in the beta. And I think the challenge, of course, is that clearly our frontline indices, at least, are heavily loaded in favor of the banking names. And clearly, while, of course, The announcement of the stimulus and, of course, the intent on reforms, I think, is fantastic. But the reality is that, come tomorrow or come next week, and we're going to be talking about still how the economy and GDP growth rate is going to be at best flat for rest of 2020 or for this financial year. And that, I think, is basically going to kind of come back to, in a way, haunt us. Because I think any stress in the real economy and any slowdown in growth or maybe even a degrowth, the direct collateral damage will be on banks. And unfortunately, in the current context, banks are essentially having a disproportionate weight on our Nifty. So I think if there were to be any correction in the global markets, we would essentially also kind of fall along with that and then probably drift lower. Of course, how much lower would, of course, depend upon how big the global correction is going to be. But nevertheless, I think if there were to be a global correction, we will drift lower. We've also seen, of course, that whenever there are corrections, we see the FPIs turning out to be huge net sellers. And if that were to really happen, then that would continue to put downward pressure on the market. So yes, I still think that probably we're not yet out of the woods completely. Of course, in the short term, we should be fine. We might catch up with some of the underperformance that we have made as the global markets have climbed up so far since the lows of March. So we might continue to outperform for maybe a few more sessions and play some kind of catch up. But post that, in terms of direction, it will be back to global markets in the very short term.
So in the interim, Nilesh, what should be the right investor strategy? If the markets were to hold up in the short term, do you think this opportunity should actually be used to book out and then pile up on cash? And when we have a durable bottom, I know it's easier said than done to try and time the market. But at least when you have some clarity on what's happening with the medical news, then perhaps, deploy that powder.
Oh, absolutely. I think it's a great idea in this kind of an environment to always have some dry powder, and either you get fresh funds or you basically sell out of maybe some of the existing positions, or you basically try and participate in the beta. And if you have some high beta names in your portfolio, it might be a great idea to basically trim, prune, or cut some positions there and raise some cash and have some dry powder, because we can't forget the fact that things are going to remain volatile. Any news on the medical front is still is potentially could be around the corner, but nevertheless, we remain in uncertain times, uncharted territory, and therefore it will always be a great idea to basically have some dry powder. And it's quite possible that a lot of high quality names, and when I say high quality, need not necessarily be the very obvious mega caps or anything like that, but I'm just saying is high quality names, capital efficient businesses could also get marked down if there is some other investor who's owning it and wants to basically sell it, and that creates a very attractive opportunity for another long-term investor. So yes, I think I don't think one would be worse off of trying to take advantage of these rallies and these pullbacks, especially if we go back closer to the 10,000 levels. Then that might be a good idea to, at that point of time, take some money off the table and have some dry powder so that you could participate at lower levels.
Nilesh, since there's this, entire sort of push on manufacturing, and I know you've talked about that, but, if we take a look at it in a little bit more detail, even with a longer term horizon, but how much, strength really is there in this mandate, given that we haven't yet seen, real credible evidence of that, or FDI coming in on that front? Do you feel post these spate of reforms, and ideally if we do hear a lot of constructive details from the finance minister, that it may well be worth investing in pockets like those with a longer term horizon? And we're saying longer term, are we looking at a 10-year view here, because these are not going to be changes that play out overnight?
Oh yeah, absolutely. Clearly, it's, as I was saying earlier as well, that this is not about just putting more money in the hands of the end consumer so that he starts basically spending or splurging the very next day. I clearly believe that global investors, especially investors who are going to bring in FDI into manufacturing or infrastructure, essentially are going to basically look at some kind of details in terms of what exactly are the reforms. Some of these reforms have timelines in the sense that if a new business is set up in the next 3 years, then of course the labor laws don't apply and things of that kind. But clearly, I think, but what the reality is that clearly global investors are looking at an alternative investment destination. Clearly, global investors have been wanting India to reform. They have been wanting to come into India for years now. And essentially, this is really that big opportunity where a lot of changes, a lot of reforms are being proposed. And this, of course, is going to take some time because obviously there are different layers of approvals or different layers through which these reforms will have to basically go through. But I think this is something which could still take a few weeks or a few months or a few quarters. So my sense is that probably it's only towards the end of this calendar year is when global investors are going to start seriously taking a look at what has changed with India in terms of the regulatory environment, in terms of the reforms, and therefore how attractive it is. A few changes have already been made earlier, things like GST, lowering the tax rates for companies, lowering tax rates, especially for manufacturing companies. Then, of course, allowing sovereign wealth funds to basically have tax-free returns if they invest into infrastructure. These are all things which have already happened. And now, of course, next is over to the land and the labor part, which is essentially the brass tacks. So my sense is that I think it will be sometime in 2021 is when we'll start seeing the first trickle of FDI actually come into areas like manufacturing and infrastructure. And probably, therefore, maybe sometime in 2020 is when you could actually get really a great time to basically buy into some of the publicly listed companies, which could benefit significantly out of a fresh inflow of FDI into areas like manufacturing and infrastructure. So I think one will have to start being very constructive, be very alert, have that list and see essentially how attractive price points become over the course of next 2 to 3 quarters and build that portfolio for the very long term. If not the next 10 years, but at least for the next 5 years.
Fantastic. Thanks, Nilesh. Good to sort of get a sense of those timelines as well and the kind of expectations we have. Great chatting with you this morning.